Welcome to this explainer. Today we're unpacking the absolute paradox of a guy who literally reshaped the global economy, Warren Buffett. We're going to take his 9-decade life story and distill it into an actionable playbook for you. Let's just dive right in. $148.9 billion. According to Forbes, as of January 2026, that was Warren Buffett's estimated net worth. I mean, that number is so massive, it's honestly hard to even wrap our heads around, right? It easily cemented him as the 9th richest person in the world at the time, and definitely one of the most successful investors in human history. But to really get it, we have to understand the man behind that mountain of money.
And here's where we hit this almost comical contrast. Despite having all those billions, Buffett's Midwestern frugality is practically legendary. He literally still lives in the exact same 5-bedroom stucco house in Omaha, Nebraska that he bought way back in 1958 for just $31,500. So this sets up the ultimate hero's journey for our explainer today. This is a guy who absolutely doesn't care about wealth for the sake of lavish spending. He cares about the compounding power of capital.
And that obsession with compounding, it didn't start on Wall Street. It started when he was just a kid. Let's trace this back to his early entrepreneurial hustles. At age 11, he's already buying his first stock. By 14, he saves up $1,200 to buy a 40-acre farm. At 15, he's pulling in $175 a month on a paper route. And get this, as a teenager, he actually claimed a $35 tax deduction for his bicycle and his watch. No way, right? Then by high school, he and a buddy buy a used pinball machine for $25, stick it in a barbershop, scale it up, and sell the whole operation for $1,200. Even as a child, he was just completely hardwired for business mechanics and generating returns. Section 1. The Value Investing Playbook. So, how exactly did that childhood hustle turn into a sophisticated framework? Well, after getting rejected by Harvard Business School, their loss, obviously, Buffett heads to Columbia University. And that is where he meets his mentor, Benjamin Graham, the guy who handed him his core investing framework. And that framework is value investing. Simply put, it's finding undervalued stocks priced below what the business is actually worth, its intrinsic value, and buying them with a wide margin of safety. Think of it like buying a dollar bill for 50 cents. Graham taught Buffett to hunt for durable, competitive businesses with strong earnings, solid brand loyalty, and real pricing power. But the absolute golden rule? Protect your capital. Buffett's famous 2 rules are, rule number 1, never lose money, and rule number 2, never forget rule number 1. That entire mindset is perfectly captured in one of his most famous quotes. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. For Buffett, the ideal holding period is just forever. And he applied this masterfully. Take Coca-Cola. He started buying shares in 1988, eventually building up a massive $1.02 billion stake. It was an incredibly lucrative move, and it's a position Berkshire Hathaway still holds today. All right. Section 2. Building Berkshire Hathaway. To actually put all these theories into practice, Buffett needed a vehicle. Back in the 1960s, he starts aggressively buying up shares of a struggling textile manufacturer for just $14.86 a share. That company? Berkshire Hathaway. Once he took the wheel, he realized the textile game was a losing battle, so he masterfully pivoted all that capital straight into the insurance sector.
Over the decades, Berkshire obviously grew into an absolute titan. And because Buffett prioritized sitting on massive reserves of cash, he was perfectly positioned when the rest of the world was totally panicking during the 2008 financial crisis. Basically, Buffett became the ultimate liquidity provider. While debt markets were completely frozen, giants like Goldman Sachs and General Electric were desperate for cash. So Buffett steps in with billions, but he secures these highly lucrative 10% dividends on preferred stock. He essentially guaranteed massive returns for himself while everyone else was losing their shirts. He even threw in $3 billion to help Dow Chemical take over Rohm and Haas. Having that mountain of capital let him dictate terms that ordinary investors literally couldn't even dream of.
But here's a twist that actually surprises a lot of people. Despite being the ultimate active stock picker, Buffett is actually a huge champion of the simple, low-cost index fund for the average person. In 2007, he made this famous bet. He wagered that a basic S&P 500 index fund would completely outperform a basket of highly paid hedge fund managers over 10 years. And guess what? He won. He constantly points out that when Wall Street managers are handling trillions of dollars and charging high fees, it's the managers reaping the outsized profits, not the clients. Moving on to Section 3, the worldview. After amassing so much unprecedented power, what does the Oracle of Omaha actually think about the world?
Looking at his public policy views gives us a really unique perspective on the American economy, straight from the vantage point of a billionaire.
Looking objectively at his stances, he frequently uses his massive platform to call out systemic issues. First off, he's described the rising costs of U.S. healthcare as a literal tapeworm on the country's economic competitiveness. Second, he very famously highlighted a stark tax disparity. He pointed out that he paid an effective federal tax rate of just 16%, mostly because of dividends and capital gains, while his own office employees were paying 33%. Because of that dynamic, he strongly favors keeping the estate tax to prevent the U.S. from turning into a plutocracy where wealth is just hoarded down a single bloodline. And finally, looking at emerging tech, he has entirely rejected Bitcoin and crypto. He famously called it rat poison squared because in his view, it completely lacks intrinsic, productive value.
Section 4. The ultimate legacy. Because at the end of the day, Buffett's true masterstroke isn't actually how he piled up all that money, it's how he's giving it all away.
The sheer scale of this is just staggering. Buffett has pledged to give away 99% of his fortune to philanthropy, keeping just 1% for his family. He even co-founded the Giving Pledge to urge other billionaires to do the exact same thing. By June 2025, he had already donated over $60 billion to charitable causes. We're talking about the largest charitable donations in human history here.
But hey, remember, this is Warren Buffett we're talking about. He doesn't just hand over capital without a rock-solid plan. When he made his massive initial pledge to the Bill and Melinda Gates Foundation, he slapped 3 incredibly strict conditions on that money. First, Bill or Melinda Gates had to be alive and active in the foundation. Second, it had to continue qualifying as a charity. And third, and this is the real kicker, the foundation must actively give away the prior year's Berkshire gift plus an additional 5% of its net assets. He intentionally structured it this way so his money is actively deployed to solve real problems right now instead of just sitting parked in some endowment.
And as for his corporate legacy at Berkshire, that was meticulously planned out too. At the investor conference in May 2025, they announced Greg Abel would take over as CEO starting January 1, 2026. Buffett stepped down from the CEO role at age 95 but remained chairman. It was a smooth, perfectly calculated transition of power.
So as we wrap up, I want to leave you with a provocative thought to ponder. We started this explainer looking at a kid who hustled selling pinball machines and somehow ended up with roughly $149 billion. But when you look at his dual legacy of fierce capitalism and unprecedented philanthropy, can true wealth be defined not by the billions you relentlessly accumulate, but by the 99% you deliberately give away? It completely reframes what it means to be successful, doesn't it? Thank you so much for joining me for this explainer. I really hope this helps you build your own playbook, and I'll catch you in the next one.